Nvidia CEO Jensen Huang reportedly frustrated with the Trump administration over delays to the chip giant's deal with the United Arab Emirates, first signed 5 months ago. That said, it has not hurt those shares, up more than 40% since the announcement in May. And that's where we'll start with Tony Huang, tech portfolio manager at T. Rowe Price. Nvidia represents more than 9% of his fund's holdings. Tony, great to have you to weigh in. So obviously, this is one potential deal, one big order among many. But how do we put it into context in terms of Nvidia's desire to essentially be the global standard and to continue to dominate the area?
Yeah, well, I think that, these large chip deals are complicated and they generally take a little longer than people expect. And so I think what really matters is that AI and agentic AI specifically is a big productivity boost. And you think about all the countries around the world that want to have that to fuel the economy and uncap essentially labor constraints. And so I think agentic AI and having digital labor is going to be the next wave, and then followed by physical AI with robotics is really exciting. So as long as that's intact, I think that that's the North Star for investors here.
According to reports, Nvidia's chip sale in the UAE is delayed. Despite reaching a $4.5 trillion valuation milestone, the stock declines after initial gains. Citing the dominance of AI infrastructure, Cantor Fitzgerald reiterates its positive outlook. As investors considered a report on delays in a multi-billion-dollar agreement to provide Nvidia's artificial intelligence chips to the United Arab Emirates, the company's stock gave up early gains on Friday. The halt occurs even though the chipmaker's market valuation just surpassed $4.5 trillion, highlighting both its fast ascent and the mounting geopolitical tensions surrounding the export of AI technology. Following a 0.9% increase on Thursday, Nvidia's stock was up 0.1% at €189.8 at lunchtime trading. A May agreement that called for the annual shipment of several 100,000 Nvidia AI chips to the United Arab Emirates is currently in limbo, according to a Wall Street Journal story. In exchange for the chips, the UAE had promised to invest in the U.S. Administration officials, however, are perplexed as to why the investment has not materialized after 5 months. According to the story, the delay has irritated senior U.S. officials, including White House AI czar David Sachs and Nvidia CEO Jensen Huang, who saw the agreement as the centerpiece of a new U.S. export strategy meant to thwart China's AI aspirations. Since export permits are necessary for Nvidia and its partners to proceed, the Commerce Department, under the direction of Secretary Howard Lutnick, has considerable influence over the future of the agreement. Although the agreement has since stagnated, Lutnick was one of its early supporters. In order to accelerate business adoption across industries including healthcare, manufacturing, and robotics, the company earlier in the day announced that it is broadening its partnership with Fujitsu to co-develop full-stack AI infrastructure. In order to create the foundation for the next stage of the AI industrial revolution, the alliance will concentrate on developing industry-specific AI agents that are built to continuously learn and adapt. The main focus of the endeavor is the use of NVLink Fusion to integrate NVIDIA's graphics processing units, GPUs, and Fujitsu's Monica CPUs. According to the corporations, the strategy will produce more specialized systems than general-purpose architectures can, adjusting computing performance to meet the needs of particular industries. Analysts have high hopes for NVIDIA's stock. NVIDIA continues to dominate conversations around AI infrastructure at the moment of the postponement. This week, the company's valuation surpassed $4.5 trillion, driven by enthusiasm for developments in artificial intelligence, such as OpenAI's recently disclosed $500 billion valuation. NVIDIA is a key player in the industry's explosive growth because its graphics processors are still essential for training and operating massive AI models. The UAE purchase has raised some concerns, but analysts are still upbeat about NVIDIA's future. With a $240 price target, Cantor Fitzgerald maintained its overweight rating on the stock, characterizing NVIDIA as the quarterbacking force behind the global rollout of AI systems and the de facto AI infrastructure provider. Concerns from the market over the possible circularity of vendor financing and the possibility of an AI bubble connected to NVIDIA's investment in OpenAI were also addressed by the company. It believes that since AI adoption is still in its infancy, NVIDIA has a clear path to $10 trillion plus market cap. Cantor reaffirmed that among AI-related stocks, Nvidia is its top pick. The enormous surge in artificial intelligence infrastructure spending, which is expected to reach $1.2 trillion by 2030, would benefit American chip makers such as Nvidia, Broadcom, Advanced Micro Devices, Marvell Technology, and Credo Technology Holding Limited. The extraordinary increase in capital expenditures, which is being driven by hyperscalers, sovereign AI programs, and enterprise adoption, may triple between 2025 and 2030, solidifying semiconductor and equipment manufacturers such as Lam Research Corp. And KLA Corp. According to Vivek Arya, an analyst at BofA Securities, the extraordinary increase in investment on artificial intelligence infrastructure will be very beneficial to U.S. semiconductor companies. With the ability to scale data center facilities and power supply as the only limitations, the analyst projects that yearly AI-related capital expenditures will nearly triple between 2025 and 2030, reaching over $1.2 trillion. He pinpoints four main causes for this expenditure. 1. Using fast computing to upgrade conventional infrastructure. 2. Protecting the e-commerce, cloud, social media, and search engine moats of key tech platforms. 3. National AI infrastructure is being built by sovereign countries. 4. Consistent use of AI productivity tools by businesses. Chip makers like Nvidia, Broadcom, AMD, Marvell, and Credo, as well as suppliers of semiconductor equipment like Lam Research and KLA, are in the best position to benefit, according to Arya. The expert contends that because current expenditure surge is backed by strong cash flows from hyperscalers and sovereign buyers, it is more resilient than previous investment cycles. With operating cash flow margins above 30%, the top 5 U.S. cloud providers are expected to devote roughly 25% of their 2025 sales to capital spending, he says. According to Arya, AI services like ChatGPT can scale rapidly without requiring expensive consumer hardware refresh cycles because end users do not need to replace their devices. The analyst has updated his cloud spending tracker to show capital expenditures of $443 billion in 2025 and $528 billion in 2026, which represents 58% and 19% growth respectively, year over year. According to the analyst, if present levels of capital expenditure intensity continue and U.S. hyperscalers account for 60-70% of the total, expenditures might reach over $1.2 trillion by 2030. Arya thinks the growth estimates are plausible considering the demand direction, even though there may be moments of digesting. Investor concerns around vendor financing are also addressed by the analyst. According to Arya, Nvidia's $100 billion pledge to OpenAI should be seen more as an aggressive investment to grow its ecosystem than as free GPUs. According to him, OpenAI needs to obtain up to 10 gigawatts of power, invest an extra $300 billion to $500 billion in equipment, and give up $100 billion in equity in order to access that funding. According to Arya, this agreement will spur other hyperscalers to speed up their competitive AI implementations. The analyst makes comparisons to the 4G cycle, in which end customers spent $3.6 trillion on smartphones, and global telecom operators invested $1.3 trillion between 2010 and 2020. On the other hand, the present AI cycle doesn't require any new consumer electronics, which speeds up and lowers the cost of adoption. Supported by its ecosystem, networking hardware, and accelerator moat, as well as by emerging catalysts like the Vera Rubin platform and its position as OpenAI's preferred partner, Nvidia continues to be Arya's top AI choice. Building on its less-than-stellar follow-through following the gap on Thursday, Nvidia appears to be marginally up in pre-market trade. On Thursday, we simply moved sideways and had a decent gap upward. We will attempt to lean somewhat to the upside, I believe. Nvidia is undoubtedly a bull market. The last thing you want is to run out of it. And I do believe that Nvidia will likely reach the $200 mark in the near future. It won't happen tomorrow, in my opinion. Since Nvidia is the market favorite, I believe you are in a position where you should keep purchasing declines in the company. With its shares reaching a new 52-week high of $191.05 on Thursday, Nvidia has had an incredible year thus far. Because of the surge in artificial intelligence, AI, which has increased demand for its graphics processing units, GPUs, and computing solutions, the stock has benefited greatly. Nvidia's stock has risen 40.5% so far this year, surpassing the increase of the computer and technology sector by 23.6%. It has even surpassed well-known semiconductor firms like Marvell Technology, Texas Instruments, and Qualcomm. While shares of Texas Instruments and Marvell Technology have decreased 2.8% and 22% respectively, Qualcomm's stock has increased 9.9% so far this year. This outperformance demonstrates that despite a market that is characterized by volatility due to trade disputes and geopolitical threats, investors are growing more optimistic about Nvidia's long-term prospects. We think that NVDA's long-term outlook supports a hold stance for the time being, and that this momentum is based on solid fundamentals. The data center division remains Nvidia's most potent growth engine. The division brought in $41.1 billion in revenue, or 87.9% of total sales, in the second quarter of fiscal 2026. This represented a startling 56% increase from the previous year and a 5% sequential growth. Higher shipments of the Blackwell GPU computing platforms, which are utilized for generative AI applications, recommendation engines, and the training and inference of huge language models, were the primary driver of the strong performance. A major driver of cloud providers and businesses' expansion of AI infrastructure has been the demand for NVIDIA's Hopper 200 and Blackwell GPU computing systems. The majority of data center revenues came from large cloud service providers, a sign of ongoing hyperscale investment in AI-driven computing. Because of its dominance in data centers, NVIDIA is a key benefit of the growing usage of AI across industries. The business is well-positioned for long-term revenue growth in this market thanks to its expertise in AI chip development. NVIDIA's financials are still very strong in spite of continuous trade and tariff battles, geopolitical problems, and macroeconomic difficulties. Revenues increased 56%, and non-GAAP earnings per share increased 54% in the second quarter of fiscal 2026 compared to the same period last year. The business maintained profitability in spite of growing operating costs, with a non-GAAP gross margin of 61%. At $31.17 billion, non-GAAP operating income increased 51% year over year, demonstrating the company's capacity to turn robust revenue growth into profits. NVIDIA continues to have a positive expectation for the third quarter of fiscal 2026. The business anticipates that third quarter revenues will reach $54 billion, up 55% year over year, as a result of the ongoing strength in demand driven by AI. A robust gross margin of 73.5% is anticipated in spite of rising expenses related to growing Blackwell production. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Okay, so all the stuff that you need to run the data center,
Correct.
effectively build the data center. So a lot of these have already been hot trades, and I guess what we're trying to figure out at this point is what hasn't run, or if it has run, how much more is there? So are there certain parts of the data center, certain stocks that you see fit that category?
So look, I think what the street is missing is that before, right, the electrical stuff, the cooling stuff, they were basically commoditized, right? You know, generally, you know, you go 10 years ago, average data center was maybe, you know, I don't know, 10 megawatts, right? And it was running at 12 volts, and, you know, you had an HVAC system, you had electrical system off the rack. You know, the big guys really wanted that reliability, so they would go to top player, but the reality is, you know, nobody thought about it, right? Now an average data center is around 100 megawatts, right? The cost per megawatt is 50 million. So that's 5 billion enterprise. And all of a sudden, because NVIDIA has accelerated its product cycle, all of a sudden they're starting to do something very different with the rack. So all of a sudden, the HVAC system, the cooling system that you had before, is not going to work. All of a sudden, the electrical stuff, when they're going to go to the Kyber rack, you will effectively have to rip out all your electrical stuff inside the data center and put in brand new electrical equipment. You're going to go to direct current architecture, running the stuff at maybe 800 volts, 400 volts versus 12 volts, right? And the problem, what NVIDIA is doing, they're completely re-architecting the rack. And all of a sudden, HVAC and electrical, which was an afterthought, right? Rubin Ultra is not going to work if you don't have the right cooling and if you don't have the right electrical connection. And just to give you a sense, we estimate roughly an average cost for data center, maybe 50 million per megawatt. So thinking about it, electrical, maybe 1.9 million out of that per megawatt. Cooling, 1.4 million. You mess that up, right? $40 million worth of chips per megawatt pretty much burn within 30 seconds.
Wow.
So that's the big difference. All of a sudden, this has become the technology bottleneck, without which NVIDIA's...
Okay, here we go. I like this because I think we're looking at the same data set. So the top story today is OpenAI being valued at $500 billion on the latest secondary round. But the big question here is where the future for OpenAI lays, on subscriptions or on enterprise. The data point that I look at is that it has a user base. We know it's like 700 million monthly, right, Caro? How much of that user base is free and then converted to being a paying subscriber? Because that kind of answers all your questions.
Yeah, so that's exactly the stat that I was referring to. From what we've seen, only about 2% of those folks actually convert over to being paying users.
2%?
Which means 2%, yes. So that means that 98% of folks that are using this actually don't find enough value to actually sort of spend money on this. Now, going back to that India data point that I was referencing earlier, if you think about those folks and you need to sort of charge, call it $20 a month for some sort of subscription to make this break-even profitability or even come close to that. In India, you have Bharti Airtel that has a deal with Perplexity that offers this service for free across Bharti's. So it becomes really hard to see where the monetization path comes on a lot of these things over the course of time. Now, the other side of this is on the enterprise side. So a lot of people say, okay, well, maybe it's more of a B2B sales. And there's a lot of things that people are investigating or looking at from the enterprise side in terms of I can use AI to get efficiencies and things like that. The MIT study, I think we all know that by now, being quoted in terms of the lack of sort of effectiveness in a lot of those. We've talked to other tech consultants recently. In fact, one of the big 3 consultant firms said that 85% of the projects that they were working on, so the 400 projects they've done on a year-to-date basis, 85% of those projects were absolutely useless. They said 15% generates some sort of benefit.
You're literally sort of echoing exactly the conversation that we had with Synthesia's CEO founder yesterday, saying basically only about 15% are even vaguely working and only 5% actually working well. But Brian, can you not think that eventually they will work? And that's actually more to implementation issues rather than actually the fact that they're not adding value?
So I think you have to show me sort of the math and the monetization and then the pathway for that working. There's a lot of data organization that needs to happen. There's a lot of things that need to happen to get to that point. And what we're seeing in terms of large language models is we're kind of peaking out in terms of what the capabilities are. And you saw that sort of transitioning from GPT-4 to GPT-5. It's not simply you throw more compute at the problem and you solve bigger and more complex large language models. There's more post-training types of things that are coming through, and you're seeing that the models are actually peaking out in terms of their effectiveness. And at the end of the day, these are extrapolators. So you're guessing what the next letter is, what the next word is based on a large training set. It can't think for you, and it can't sort of make those decisions for you. And I think you're starting to see that within the enterprise side of things. Now, to pivot to an even bigger question here is where has this spending actually come through? And where are we actually seeing the money spent? And that is actually more on the hyperscaler side of things. So actually providing the cloud services where the data is coming through